We all know that things had their fundamentals. One example is accounting. In this video, we will talk about the fundamentals of accounting. Our outline for today is the definition of accounting, its basic formula, the distinction between the owner and entity, and finally, we will talk about the profit. We start from the definition of accounting, formulated by Committee of Accounting Terminology of the American Institute of Certified Public Accountants, or AICPA, which says, "It is an art of recording, classifying, summarizing in a significant matter and in terms of money, transactions, and events which are in part, at least, of a financial character and interpreting the results thereof." From the definition, we can understand that accounting is a form of record keeping. Those records are then classified into three basic categories. First is the asset. Second is the liability. And third is the capital. After the classification, the items in those categories are summed up, and finally, those totals are interpreted. To summarize even further, we have this equation. C plus L equals A, where C is the amount raised by the owner from his own pocket or from his or her own good credit line. L is the amount owed by the entity from another entities or persons. A comprises all the amount raised by the owner or owed by the entity. Always remember that the owner is separate from the entity. Treat the entity as another person. For example, treat it like the child of the owner. Let's talk about the word entity. The entity is an artificial person created by an owner or group of owners to transact business. Talking about the advantages and disadvantages of forming an entity will be discussed in another video. Just think that an entity is like a big child, not knowing what to do but guided by the owners. What are the owners? Owners are natural persons that are of legal age and had the capacity to enter into a contract. A more detailed discussion of owners would be for another video. All businesses need profit to continue its operations, and profit contains two important points. First is the income, or some call it revenue. This is the lifeblood of the business, and without it, the business would close. Second are the expenses. These are the necessary sacrifices for the business to complete a transaction. And without those sacrifices, the business will not move toward its goal, to make profit. There is profit when, if the income is greater than expenses. Loss if expenses are greater than the income. The simple fact for a good business is to maximize profit while controlling the expenses. Profit increases capital, and this would mean that it is added to capital, while loss decreases capital. Therefore, it would be subtracted from the capital. That's all for today. If you like this video, please click like and subscribe, and may you pass your exams.